You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. Time to dial up the old Advisor's Option, see what's going on at the intersection of financial advisors and asset managers, and of course, the growing, some might say, exploding world of options. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network that continues to explode itself, including new additions to the network. So if you've always been, let's say, futures curious, maybe you're just intrigued by all things futures, you want to dip your toes in, you don't know where to start, got a brand new show just for you, the Futures Rundown, every Wednesday. It's been coming up on, it'll be almost a 2-month anniversary next week. How crazy is that? It's already 2 months in. Folks are loving it. Glad to see the response has been so strong. People are stopping me at events, telling me how much they enjoy the Futures Rundown. So it's been a fun ride. Glad to see so many people having fun. Another reason, if you're just listening to the Advisor's Option out there, make sure you're listening to the full network. A lot of great content coming at you. Nearly a dozen programs for you to enjoy wherever and whenever you are. As we see who's joining us on the old program today. First, let's go out. I know where he is. I think I do anyway. He should be hanging out on the old shores of New Hampshire. Yes, there is a shoreline. Not much of one, but it does exist. But we are joined once again by Mr. Matt Amberson from ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the show. How are things in ORATS land, sir?
Things are great. Things are busy. We got through our live data And now we're into and back where we were before, just developing and supporting and doing research and such. And then we're getting into this election and doing some stuff. So it's been busy, Mark, and the leaves are turning, but it's still beautiful out here in New Hampshire.
Yeah, early fall, good time to be up there in New England. Foliage season, a hot time up there. So we're looking forward to having our guest on. We are joined for the first time on this program. He has been on VolViews back, I believe it was May of this year, so about 5 months ago. We are joined once again by Zed Francis, the Chief Investment Officer and co-founder of Convexitas. Zed, welcome to the Advisors Option Program.
Thanks much for having me. And out of interest, does the music lead to this? The start of Americana and the Offspring album? That's what my brain was going to.
No, it's not. But we could pretend that is, if that sounds. I've never heard that song. I'll have to go check it out now. It's custom music for the show, but maybe they were inspired by that. Let's just
definitely go listen to it tonight.
I haven't checked out Offspring in a while, so that might be kind of fun. And Zed, this is your first appearance on this program, so for the listeners of this show, I'll give our audience a bit of an overview of your background in the financial space, as well as what it is you folks do over there at Convexitas.
Yeah, absolutely. So we're providing highly discretionary derivative overlay strategies specifically to the wealth channel. My career has ebbed and flowed from hedge fund, large asset manager, to finally ending up in the wealth channel, trying to bring highly tax efficient option strategies to the RA community out there. So it's a good meandering to end up in a place there. We really think there's a decent amount of incremental value that we can bring to the table.
All right, so let's commence bringing that value, listeners, with a little bit of the old P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment born of the pandemic because we spent so much time on every episode saying, man, what the heck just happened? So many crazy things were happening week in and month after month out there that it became its own segment. And now, of course, we have big things in the offing to discuss as well. As we are recording this, listeners, we are pretty much exactly a week away from the big day here in the U.S. Hopefully, when you're listening to this down the road, you'll already know the answer. We'll all collectively, hopefully, already know the answer, but it is still very much up in the air as we speak. So a lot to unpack there. Of course, markets, for the most part, since our last show and heading into the election, seem like they've done mostly what I would term a gentle drift higher. There has been some malaise. There has been a little bit of whipsaw-y action where we start in one direction one day, usually green, then maybe we end a little bit red by the end of the day. So it hasn't been the triumphant rampaging bull that we've seen of late, but it has been a gentle drift to the upside. As we're recording it today, markets are a little bit mixed out there. We are in the middle of earnings season. That's weighing on some things. We'll, of course, get to that in a little bit as well. And our old pal VIX heading into the exactly 1 week before the election, still hanging out a little bit shy of a 20, right around 19.5 as we're kicking off the show. All right, the table is set. Zed, we will start with you as our guest, sir. A lot to unpack. What is catching your eye in these markets and indeed volatility leading into the big day next week, sir?
Yeah, absolutely. So specifically talking about S&P 500 volatility, my theme is vol is just too darn high. And to kind of set the table for that, next Monday, so yes, we have non-farm payrolls Friday, but Monday before the election, S&P volatility is a little bit more than a 14. Next Friday, so that has all the events, potentially multi-day event, election, FOMC meeting, non-farm payrolls is Friday. That volatility is kind of a 19.5. And then year-end volatility, December 31st, is kind of like a 15. I'm just talking at the money S&P 500 volatility. And why I run through that and just say vol is just too darn high is close of close, realized volatility last month is a 9. Close of close volatility the last 2 weeks is a 6. And if you look at just intraday volatility, so you take the high and the low of the S&P 500 every single day, the realized is like a 3.5. So we've just been, as you said, doing the kind of grind higher, But close to close, we aren't really moving, and intraday, we're really, really not moving. So it's pretty darn expensive volatility out there, and I find that kind of interesting. Why volatility's remained so well bid? Yes, we have a known event, all those kinds of things, but this has been a spectacular risk-adjusted returns year. It's not like we had a scary event and now things are having a little bit of calm before the next event. The return over realized volatility this year is the fourth highest since 1990. The only years where we've had better risk-adjusted returns, obviously thus far we have 2 more months left in this year, but the only years we've had better risk-adjusted returns were 1995, 2017, which we all know is the year where vol came to die.
I was just about to say, I bet you 2017 snuck in there somehow.
That's right. And then 2013. So it has been a spectacular year of strong returns and very little realized volatility. And yet this event is really, really elevating volatility, at least thus far.
Ah, yes. The good old days of 2017. Who could forget when vol just went to die? You're right. We could be on the cusp of that again if we see a repeat. Trump wins, who knows? Everyone said last time, the one thing this guy isn't is a single-digit VIX president. He turned out to be exactly that for the first year of his presidency anyway, so maybe we'll see a repeat of that. Intriguing. Since you brought up vol, I will put this out there for you guys to mull over, and I'll get your thoughts in a second. But that is very much in line with our question of the week right now. We're asking our audience over there. We have one more full trading week before the big day. Anything can still happen. Surprises can still unfold, which raises the question, where do you think VIX is going to close? Not next week, not around the election, but this week, at the end of this week on Friday, heading into the election. We gave you 4 choices, nice wide ranges you can sink your teeth into, right around here where it's vacillating right now, somewhere between 18 and 21, or a little bit lower, below 18, or a little bit higher, 21 to 24, or still higher, so north of 24. Zed, gun to your head, if you had to come up with a vote in that poll, where are you leaning? Sounds like you're leaning below 18. You think vol's too high?
No, this Friday we're going to hang out. We'll be exactly essentially where we are right now, even after NFP rolls off, because I definitely think the event next week is what's drawing the attention. So I'll take the middle zone of boring. We'll be exactly where we're at come Friday.
Okay, 18 to 21. Well, you're not alone. Some other people are joining you in that vote. Mr. Matt, same question for you. We'll start with your vote in our question of the week. Then I'll reveal the results in a little bit, even though I did kind of give you a spoiler there. And then little event, a little potential catalyst coming up next week, sir. What's catching your eye?
Interesting what Ned said. Yeah, definitely actual volatility is quite low. And what we've seen, that really is the implied move for earnings has been coming way down. So my answer to the VIX, I think it's going to continue lower. So it's going to drift a few points lower, I think, from here. And just because I think, more certainty in the election is really, so what ORATS does is we have this, term structure and we have a simulated move event, and then we solve for a rational term structure. I know it sounds a little bit complicated, but we use it all the time for earnings and figuring out what the implied earnings move is, especially when there's not a straddle real close by. We do a good job of figuring out what the actual market is thinking about the moves. So we've done this now for the election. And for some context, back in August, we had a little bit of volatility back in August. There was the SPX was thinking that it was going to be about a 2.5% move back then, which is a fairly large move. And let's see, Energy's XLE had about a 3.7% move. So that was the highest of the kind of segments that we looked at. But now they're all the way down to where SPX is only saying a 1.5% move after the election. Energy is down at about 2.2% move. So everything's just coming in, just falling off the cliff as far as expectations for the move, expectations for what's going to happen around the election. So that's been kind of one of the most interesting things that we've been seeing out there. Of course, we'll talk about earnings later. That we're right in the middle of that. So it's been one of the things that we always talk about at earnings is happening this earnings. So I'm sure we'll get to that later. But yeah, and then contango is starting to move towards backwardation, and that's not good, but that makes sense for what's coming up. So a lot of people are really kind of jacking up front month vol, even though the event itself has been coming down. I think what's going to happen is the election is going to be kind of a non-issue, and then we're just going to move on from there. So that's how things are looking to me, Mark.
The election is a non-issue. I guess we should just cancel our election night extravaganza. I guess no reason to be on the network.
That's too fun, Mark.
They are pretty fun. We've had a lot of fun surprises on that. By the way, if you want to see some hard data for what Matt is talking about, they have a whole article breaking it all down on the ORATS website, orats.com, listeners. It's just called Implied Moves Ahead of the 24 Election, What Markets Are Telling Us. Here's some numbers that may surprise you, listeners. Gold, GLD, implied moves down 42.3% since August. Maybe energy. How about a little XLE action? Down 38.9% over that same time frame. SPX implied move down 40%. Even the 10-year. We've been talking about rates vol and yield vol in general a lot lately on the network. 10-year bond, the TLT fund vol has dropped by 23% over that same time frame, about 3 months. So yeah. Again, who had the massive annihilation of vol heading into the election on their bingo card? I know I didn't. Maybe after the election, certainly, but heading into it, that's interesting. But that's kind of what we're seeing across the board, which is kind of fascinating. Speaking of the annihilation of vol, let's check in. We have everyone's votes here on the show. Let's see how you folks are actually voting in our question of the week right now. And I kind of gave away a spoiler earlier. Before I say that, Matt, what is your official vote in our question of the week? Where do you think VIX is going to be here? 18 to 21? Did you say a little lower, below 18? Higher, 21 to 24, or even higher, north of 24, sir?
No, I'll say below 18.
Wow. All right. We got ourselves a market here. Our audience right now, 35.9% saying right around here where it's vacillating right now, 18 to 21. Then we have 25.6% for number two, say it's going to be north of 24. They're feeling a little bit of juice by the end of the week. 20.5% say 20 to 24, and then 17.9% joining Matt at below 18. So we got quite a diverse array of opinions. That is what makes a market at the end of the day, and who knows? Many things can still happen. We still haven't technically gotten our October surprise, so who knows? Maybe we'll get an early November surprise, or maybe nothing at all. Maybe that will be the surprise. Either way, get over there at Options to make your voice heard. And you know what, listeners? Since we're talking about this big event coming up next week, this big potential catalyst for markets and for volatility and for everything else, it seemed like a good time for a little bit of Options 101.
It's time to learn how to use options to manage risk and generate additional income for your clients. It's time for Options 101.
All right, listeners, welcome to Options 101, where, as the name implies, you break down some basic or sometimes a little bit more elaborate options concepts and explain how you can utilize them in your clients' portfolios. And today we're kind of reviewing a concept we've touched on a number of times in the past, which is hedging. Again, go into our archives if you're one of our newer listeners. We have delved into this issue many times, how to hedge, how to reduce the cost for hedging, all different episodes on that over the long run of this show. But coming up next week, we have what can be charitably described as event risk. Although you've listened to what Matt and what Zed were just saying, maybe the vol is a little overdone. Maybe the vol is starting to come in ahead of this. I just came off our pro Q&A a little while ago. The guest there was saying kind of the same thing, that we might even know with some of the early results, have a pretty good indication before the announcement on Tuesday night who's really in charge or who's really leading the race, which case that would probably depress vol as well. So either way, though, it is a very large event looming on the horizon. So it seems like a good opportunity to explore some methods you might want to utilize to hedge this very specific event risk. And it's an interesting time to do this now because this is also the first election, the first presidential election, where we have these new tools at our disposal, aka all the zero-day funds. I think we'll get into that a little bit as well. But let's start with the basics, the obvious. You're looking at an event coming up next week, and we're going to look at this mostly through the lens of the broad indexes. That's where a lot of advisors like to play. That's where they like to put a lot of their client assets, and that's where they're usually looking to hedge. But you could usually, with a few exceptions, we'll point those out for you, but usually with a few exceptions, you can usually use these same techniques in the single names as well, if that's your bag instead. So let's talk about just straight puts and put spreads. Zed, if I told you right now, okay, I'm an advisor, I'm out there, my clients are calling me up, they're understandably a little bit concerned, a little bit skittish about the big event coming up next week. Maybe we have a surprise, maybe we have lingering uncertainty for a while after, maybe it's all over very quickly, who knows? But folks are obviously a little bit uneasy right now, and they're looking to put some hedges on around this event. How would you counsel your clients, Zed?
Yeah, so absolutely. So, what's important first off is that these markets are changing quite rapidly. So doing anything on a habitual basis will eventually lead to some problems, i.e., don't always do the same thing 24/7. You have to read the tea leaves of what's going on and look to implement a strategy best considering what's going on in terms of pricing of options. Currently, skew is incredibly steep coming into this event, meaning puts are expensive relative to calls, and further out of the money puts are expensive relative to close to the money puts. So even though I would argue that implied volatility is a little elevated considering how little we've been moving both this year and this last month, utilizing put spreads to take advantage of the steep skew is the simplistic way of thinking about implementing a hedge at this point in time. And my final 2 cents is, before you enter anything, make sure you have a known defined monetization process, because we often see the main issue is when you enter these positions, even if it's a solid position and even works in your favor, what is the process to actually take off that position, either once the events happen or the market's moved? Predefine what your plan is after the event or after the market move.
That's an excellent point, because we've seen so many times here on this network, someone put on a well-timed hedge and then do nothing with it, and then the stock sells off and then it rebounds again and the hedge ends up going out worthless, and they missed a great opportunity to monetize and really put that hedge to work for them. At the end of the day, listeners, you put on a hedge, the goal is to monetize it in some way, shape, or form. So if you don't do that, you are missing out on a very crucial aspect of the process. So Zed kind of broke it down. The two most obvious ways to go about hedging very specific event risk is, of course, the most obvious is just the straight put. You're buying an out-of-the-money option typically. How far out of the money is really up to you and your client, how much event risk you really want to hedge, how much, of course, you are willing to pay for that protection. That's going to dictate how far out of the money you go. The pros of buying a straight put, we've said it many times on this network. At the end of the day, everyone talks about inverse correlations and what the correlation is between this and that, and is Bitcoin inversely or negatively, all these different things. At the end of the day, we've all seen many examples of when it all hits the fan, correlation tends to go to 1. At the end of the day, the only contractually guaranteed inverse correlation is a put option. So if you buy this put option, you have that protection in your back pocket for a rainy day. And it can be a good feeling. These days, sometimes I think we undersell the value of being able to sleep at night, and certainly for a lot of your clients, that might be a value that they're willing to pay for. So something to bear in mind. If you're buying straight out of the money puts, that's something you can at least sleep at night at the end of the day. Now, the downside, Zed kind of alluded to it. Things are pretty juicy right now. Things are pretty expensive. We talked about skew in the past here on this show. That skew is certainly elevated right now. Those put options in particular are fairly expensive for all the reasons you might imagine. Everyone's piling into their hedges. Things are a little bit loosey-goosey right now with the election looming on the horizon, and also just in general where we are from an overall valuation perspective. Some people may be thinking, maybe we're getting a little bit top-heavy here, but we shall see. Either way, there's a demand for puts that is reflected in the skew. That means they're expensive. So if you come out and just buy them straight up, it's going to cost you an arm and maybe a little bit of a leg and maybe a little bit of left hand as well. So just something to bear in mind. That's why Zed and a lot of people right now are looking at instead doing put spreads taking advantage of that skew to sell a farther out of the money put against it, and that will allow you to defray some of that cost. Of course, the downside is you're not hedging everything. So you have to determine at the outset what really range of protection you're looking to get, because if you blow through that short put strike to the downside, your hedge is done. So just something to bear in mind, two very straightforward approaches. Matt, we've talked about these, you and I, many times on this show. What are your thoughts of going the straight put or indeed the put spread route right now to hedge very specific imminent event risk like the election, sir?
Yeah, I think what Zed said is a very good point. The skew is steep. We've talked about how the skew has been pretty shallow, and my case is that it's a lot of it because of zero DTEs allowing market makers to spread their books off, but it's getting steep again, so there must be a bunch of people hedging. So yeah, definitely I'd consider strongly a put spread, or my favorite, the put calendar. But since we're talking about puts and put spreads.
We'll get to the calendar. I knew you were going to get there. We'll get to the calendar in a second, sir. Don't worry.
Yeah. But, my favorite thing is, you go to these RMC events and you see them talking about protecting your portfolio with all these obscure and other investments, but puts are contractually going to pay off. So of course, I like that. They can get expensive, but I'm just looking at our ORATS option scanner, and there's an end of Nov 10-point wide, 568, 557, so 9-point wide. We're at 581 right now in SPY for $1.91. It's 1/3%. So it's not that expensive. So that would give you some decent protection. Of course, I'm not recommending any specific securities here, but something along those lines are interesting. And also, ORATS has 181 million and counting back tests where we test things that Zed also brought up of how to get out. And we test various exit strategies. Stop losses, but in this case, a stop profit target, where we look at, 100, 200, 300, where you're going to get out. It's very helpful to have a percentage, or you could mix and match. What I always told the market makers that I was backing was, if you get a big move in your favor, immediately take off 20%, and then watch it closely to take off another 40. So now you have 60% off, and then you kind of hold on to the 20 and do that one next, and then hold on to the other 20 almost till the thing expires. So that's how I would think about it, Mark, and getting in, getting out, what type of strategies with this event and all the other commotion that's going to happen. Those are things I like to think about, Mark.
All right, and I did mention one of the interesting things about this election. We've obviously had puts for a long time, and we've had expiration day puts since options were invented, but they were only once a month. Back in the day, back in the halcyon days of options. Obviously, that's not the case anymore. Now we have these 0-day options, which are taking the options world by storm. So for many people who in the past maybe already would have been putting on hedges around the election, maybe buying expiring that week after or right around that time, maybe going out a full month, you don't really need to do that anymore if that is what you are interested in. So this 0-day phenomenon, how does it change the event risk hedging game? Well, it does in some very interesting ways, because at the end of the day, that's what these products were really and truly designed for. I mean, obviously people have embraced them from a speculatory perspective. That's driving a lot of the flow right now. But the core mission, if you want to say that, the core reason for these products were created was really to allow hedging around very specific events, like the Fed, like the earnings, if we do ever get a single name, 0-day contracts, and of course, big events like the election. So the pros to buying, let's say, a 0-day S&P 500 put versus a monthly or even a weekly S&P 500 put should be pretty obvious. It's going to be a very extremely specific hedge for the event you're looking for. So if you want to just tailor it for one event for just a few hours that really concern you, that's going to work. And also the other pro is it's going to be much cheaper. So if you're really concerned about cost, 0-day is probably going to be your lowest barrier to entry in terms of coming in, just going for straight hedging for that specific event in and of itself. You're really only buying the protection that you want and or need. Now, the downside of that obviously is pretty straightforward as well. For example, if the election spills over and we get one of these things that nobody wants where it's contested and the results are contested. I was down on the floor, I think Matt was too, for all the fun around 2000 Bush versus Gore, and that was about a month and change. I think that persisted for, and the markets roiled for the better part of a month with every new hanging Chad that was discovered down there in Florida. So if we get a repeat of that, obviously the 0-day put not really going to help you that much. And again, right now, if a lot of your clients are concentrated in single names, 0-day not really going to be an option for you either. They're really limited to the major indexes right now. I know for a lot of advisors on the option front, the pushback we've had for years is the time element. And if you're regularly incorporating 0-day options into your routine for your clients, it's going to up the work factor, the time commitment factor for a lot of advisors. And I know for a lot of advisors hearing from you doing this show for a long time, that could potentially be a deal breaker as well. Now, obviously doing it once for the election, a little bit of a different beast than doing it daily or weekly out there, but just something to bear in mind. So Zed, I don't know if you and I have talked about 0-day, so let's start there. I know Matt is a fan. Where do you fall on the whole notion of 0-day options? Are you a fan? Are you not a fan? And then B, for our specific use case here, talking for advisors looking to hedge around specific events for their clients, what are your thoughts about using 0-day options for that?
Well, I mean, I think all, products are essentially a tool. And the question is, how do you use the tool appropriately in your day-to-day processes? I would think that for most advisory clients, using single-day options as a tool, as you said, is probably a little overly burdensome and probably, I would say, conflates a little bit with the messaging that they have with their end clients that, we're investing for the long term. But they're definitely a very useful tool when you see mispricings on specific events or potential opportunities related to 1 day versus 3 day and things along those lines. So as a professional, I find them to be a very useful tool. But yeah, I would think there's a little bit of a crossing streams using a 1 day tool versus a long-term style investment horizon for most of the messaging for advisors.
I have been kind of wondering as well, because usually in this period, a week leading into a big event like the election, we would start seeing some of the volume ramp up, particularly some of the hedging volume. And we're not seeing that. The ADV is coming in across the board, S&P 500, also in VIX and other products like that. So I do kind of wonder if people are keeping their powder dry until the actual day now. I think some of this 0-day phenomenon might be siphoning some of the volume we would traditionally already be seeing right now in terms of hedging activity. So a very different game now than it was even a couple of years ago when we first entered this 0-day foray. Matt, I know you're one of the biggest 0-day proponents that I know. You're a big fan. So what are your thoughts about advisors utilizing them as a tool to hedge specific event risk like the election?
Yeah, I think the good thing about 0DTs for advisors is that they're there every day and you could have a consistent strategy that you can communicate to your clients. As far as hedging a specific event, I don't think they're that appropriate. You can do some things, however, very short term, if it's just a couple of days or a day, to protect something, it wouldn't cost that much. You could buy a lot of out of the money premium for not too much, and get some protection if your clients are totally on board. As my argument has always been that the 0DTE trading is both ways, and there's a lot of liquidity, and allows market makers to hedge their kind of traditional positions that they end up with, which is, they're selling puts to banks and they're buying calls from covered call traders. So they have this big long call position and short put position, and that's why the skew gets steep. But with 0DTEs, they could often offset that. And I think that right when 0DTEs really came into play, you saw the skew in the market flatten out, meaning the puts were getting closer to the calls. So that has been good for advisors wanting to use hedges, and not having to pay up for the market maker's lack of inventory there. So that's how I feel, Mark, about the zero DTE product.
Interesting. I thought you'd be all over utilizing them. They're kind of your favorite thing, but you don't like them in this specific use case, sir.
Well, I mean, I trade them, but as far as communicating that to your clients, for advisors, I think it's a little bit of a difficult sell. It is expensive. It is whippy. There's a lot of risk around stock moving in and out, and even though SPX settles in the cash, there's still a lot of whippiness that happens, and you have to be on it. It takes a lot of time. So there's a lot of concerns there. So yeah, for this purpose, it wouldn't be my go-to for protection. It's my go-to for creating a kind of daily way to collect some premium, but it's not for just an event protection, Mark.
So there you go, listeners, some outlooks on whether you should or maybe shouldn't use them. And yeah, for a lot of advisors, I know the management aspect is a big issue, especially if you have a lot of clients. So it is something to bear in mind. Let's go through a few others here because it is a big event in the offing, things we've talked about before on this show. I've talked many times in the past. I only have jokingly referred to this as the kind of holy grail position for a lot of financial advisors out there. It is the collar, of course, buying an out of the money put like we were just talking about, and then you're going to turn around and sell a covered call against it as well. So remember, you have the underlying position as well. So it's a way to defer some of the cost of that put. You can go even farther if you can buy that put spread now. So you're buying the put, selling an out of the money put against it, and also selling a covered call against it. So now you have two income components to reduce the cost of that put. If you're looking at puts right now and saying they're kind of expensive, that is one way you can go about defraying their cost. Again, go into our archives to see the many episodes we've done on collars and the many variations and permutations therein. But of course, the same caveats apply. You're going to be limiting your upside, and you're going to be capping your hedge to the downside as well. So just be aware of that. Zed, what are your thoughts on collars right now, and maybe some other ways you think clients, or I should say advisors, should go about hedging specific event risk for their clients right now?
Yeah, so, I guess maybe an overly strong statement, but I'm essentially not a fan of selling index calls. Two reasons for that. One, I actually think they're generically inexpensive relative to the rest of the S&P 500 volatility surface. Your array of different dates and puts and calls, out of the money calls tend to be inexpensive relative to the rest. So I think you're selling something that you're not getting fully compensated for, along with, to me, the point of holding equities in a portfolio is for that quote unquote unlimited upside, like converting your equity exposure into something that it looks more like fixed income doesn't, from a kind of structural standpoint, make a ton of sense to me. So to me, I would rather than defraying the cost from selling a call, to me that's more of like a sizing decision, like own less of outright puts or own put spreads rather than capping upside in your equity portfolio, likely selling something that's inexpensive relative to the rest of the options in the S&P 500. Only because Matt brought it up. I think it's probably difficult for the average advisor to implement on their own, but I am a big fan of calendar put spreads. I think you can get pretty significant mispricings on both what you're buying and what you're selling. That's very attractive, and there's a heck of a lot of positive convexity in that positioning, meaning as the market moves, you're probably expanding in the correct direction, i.e. market goes down, your hedge is expanding much more quickly, and vice versa, market goes up, your hedge is reducing much more quickly. So to me, there's a lot of both structural things that make the calendar attractive, but also from a risk profile, I find it very attractive.
Uh-oh, I can hear Matt getting excited already. I think we have two simpatico minds on all things calendar puts. I'm going to toss to him in a second because I know he's very excited about this. But really quickly, since we're talking about him, how do you like to typically structure your calendars using puts? Are you going straight at the money? Are you going a certain percentage out of the money? Are you going more of a diagonal? How do you like to set them up?
Yeah, so the calendar that we tend to lean on is we're buying slightly out of the money, shorter dated puts. We're selling further out of the money, longer dated puts, and we're targeting very specific points in the calendar where we think that there's structural edge from products that are created out there and/or folks that have to participate in certain parts of the S&P 500. So that's kind of our general thematic means of implementing our hedging strategy for folks.
And Mr. Matt, I know you've been waiting patiently all episode long, sir. The floor is yours. I've set aside our remaining 19 minutes for you to regale us on the joys of put calendars and diagonals, sir. Have at it. The floor is yours.
I could just sit back and listen to Zed and sit next to a fire and just have a big smile on my face and just have him talk about diagonal calendar puts, and I'll be very happy. But that's the way to look at it, And Zed brought up also the just typical positions that market makers have on. You want to trade around that. You want to buy what's cheap on the skew and sell what's expensive on the skew, and that's why I like those types of products. And also just because it's often theta positive, and often when it goes down to that area, the volatility that you own pops, and so you just get a double whammy there, and it doesn't cost a lot if the market's rallying. I do a thing called the permanent portfolio, where you own gold, where you own cash, where you own stocks and bonds, and I do options around them. Like now, and I have Bitcoin, as and do the BITO caller, and now that's really rallied, but it's just up to my short calls. And I agree with what Zed's saying. Often these calls, it's not worth it to sell, and often if you look at the actual moves of equities, you'll get most of your appreciation in just a few days. So if you're giving up those few days of appreciation, you've lost a lot of the reason for owning equities. So you really have to watch it. That's why I like more, again, calendars there and call spreads. So you're not just giving up these massive moves to the upside. And I manage them pretty aggressively, meaning, let's just say I sell a call spread. I start to move my long down towards the short almost immediately. So as that short spread is wide at the beginning, but then it starts to narrow down. When you get little blips here and there, you could really kind of narrow that window and still not pay that much in comparison to the amount that you brought in at the beginning. I don't know if that makes sense or not, but a lot of these things you need to manage, not only when you're going to get out of them, but manage it and try to roll and tighten up your risk on the upside and be able to participate more, even if it goes towards your short, which is happening in BITO and gold. They had good days today. And it looks like Google's having a good earnings just now. It came out. So that's how I think about it, Mark.
Yeah, BITO on a tear. I was just looking at it earlier today. I guess they're thinking the election goes a certain way, might be more favorable for the crypto. Either way, the rampage there as well. Speaking of things going well, let's get out now to a little bit of the old earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, another segment that was born of the pandemic because we started looking at these numbers and we said, wow, this really doesn't make much sense. Earnings vol is going to die. Well, that certainly is not the case any longer. Vol has certainly come roaring back to life as we're hanging out right now coming into this season, listeners. Our long-term average, which again is a trailing 12 quarters. It might be interesting to go back and look at the entirety of all the data we've crunched on this, see what the full long-term average is. Might be a good question for Otto. But right now we're hanging out at about 114%. Obviously 100% means if we move exactly as much as pretty much every straddle is pricing in, then that would be 100%. So 114% shows clearly things have gotten spicier, things have gotten a little bit more volatile over the last couple of cycles. But Matt, you are the guy who crunches this data. So when you're not talking to us here on the show, you're out there crunching a lot of earnings vol. We got a couple of weeks under our belts now, and so far we're looking even spicier if that's possible. 129% so far as we're part of the way through week 2. So a lot to unpack. Well, let's start. What are your thoughts on the previous cycle now that it is in the rearview mirror? And then B, what is catching your eye in yet another hot start to earnings season, sir?
Yeah, as we talk about, when volatility is not totally pumped up and earnings start to mean more, we really see a lot more people making money owning straddles, which is really what the earnings season report is about. How are people doing around earnings owning straddles? Not that we're pumping that, but we're just looking at it from that factor. It's easier to think about, I think. One of the things, and last earnings cycle was pretty positive for the people that own straddles. And this earnings season is also profitable for people that own straddles. What I've seen is the earnings were really undervalued going in. You can see them right away, like in the 4.5% when things are moving in the 5s. And so, generally what we see is, of the 6 weeks that we call an earnings season, week 1 has a few of the bigger companies. They're not that exciting usually. That's usually, more of a break even. And then as you continue out in the weeks 3 and 4, those are usually the best for earnings straddles. And then after that, it gets a little bit messier for when the smaller companies come out. And we've seen a really strong week 2 for people owning straddles. There's been quite a bit of movement out there. I think that the single stock implied volatilities haven't really been jacked up for the earnings. And given what there's been a lot of surprises on the earnings, and it's been moving the stocks, but it really hasn't moved what people are implying the price of that move. So what we see are people that own straddles making money on this one. And, usually what we see when there's a big event like COVID, like the election, is people tend to ignore earnings and the moves aren't that big. But now we're not seeing as much of that. Whether it be, like we pointed out earlier, the earnings are not being as overshadowed as the election gets a little bit more. I would say, the implied move around the election has come way, way down. And so I think that, that's actually helped this earnings season. So those are the things that I think about on this earnings season, Mark, and how we're doing.
Zed, you mentioned at the top of the show, your lens for the market is really through the broad index and index volatility. How big of a part does earnings season and all the various movements and developments that we see as a result of it, how big of a part does it play for you folks over there at Convexitas? And also, on a related question, it seems like a lot of people are getting into the dispersion game these days. And, earnings season very much plays a part in that, the movement of the components versus the index as a whole. Is that a lens through which you like to view the earnings season movements?
Yeah. So our flagship product definitely is S&P 500 options. And as you say, dispersion is very interesting, especially, this frankly calendar year where correlations have been very, very, very low, meaning, sure, underneath the hood, single names are moving at a pretty normal pace, but they're moving in different directions every single day. Thus, index volatility has been suppressed. And we definitely pay attention to that because ultimately the kind of coils the spring, if you will, of correlation normalizes, then you can get a really big pickup in index volatility even with all the constituents moving exactly the same as they have been. So we definitely pay attention to that to add additional convexity into the portfolio from an index set of things. One of the other strategies we run is actually a sector replacement strategy in the semiconductors sector, where ultimately we own volatility in the index and we're selling volatility in the single names. And so those specific names earnings are very much on our radar consistently. And I almost have like a question for Matt for this earnings season, whether he's been seeing it in other sectors. What I found very interesting in the semi space this quarter so far, and we're halfway through earnings season for semis, is the implied volatility for expected move on earnings has gotten bid up a good 2 weeks in advance of earnings, but then the day or two prior to the release, volatility compresses. So we've had this weird cycle of markets seemingly pricing in a greater than historical move on earnings. And then by the time you get to the event, it's all the way back to normalizing. And I'm wondering if that's what you've seen in other sectors.
Yeah, that's interesting that you say that, because on our searches, we usually go quite short term, but we're seeing some stocks pop up that are completely overvalued. And I think AMD was one of them. And what you could do on those is you could just start that calendar earlier. And yeah, I mean, we've been seeing that where then the implied move then settles down. So it's not necessarily an earnings move that you're looking for, but you're looking for the implied move to come back to normal before the actual earnings and get out before the earnings. So we have seen that. That's interesting that you say that. And I wasn't really thinking about it on a macro level. I just saw it popping off here and there. We have a stock scanner that shows those, and there have been more of those recently, Ted.
No, I mean, AMD is a great example. Obviously, they just reported too. But AMD was closer to a, call it 9% expected move on earnings, a week plus ago. And then we went out today much closer to call it, a 7 and change, which I would call as reasonably normal. So anyway, it's just been something I found very interesting, that the risk on earnings seems to expand, call it 2 weeks ahead of time. But then by the time we get to the event, everybody's kind of compressed that earnings move volatility down to historical norms.
Yeah, 7.6, we have AMD. It's historical over the last 12 quarters is 7.7. So we watch that, and if it gets out of line, that's a trade. That's a decent thing to watch. Now you don't have to, but you can hold it through. But often it'll self-adjust as earnings get closer.
All right, and we'll adjust here on the show. We got a few minutes left. I think we can squeeze in a couple of people in the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, let's get to it here on the office hours. First, this might get my award for handle of the week. I just like this. Los Excelente. Los Excelentes says, hello from Santa Fe. Well, hello, Los Excelente. We've had people write in from all over the place. I can't specifically recall anyone writing in from Santa Fe before, so you might get pride of place for that one. And you also get pride of place for an awesome handle. Can't stop laughing. Los Excelente says, I would appreciate it if the program could discuss the new marketplaces for trading binary options on the election. It seems like all of this is coming online very quickly. What are your thoughts on these new venues? Do you think that these types of event contracts will become a larger part of the asset management landscape going forward? Well, great question, Los Excelente, and also just awesome handle. I love it. Tip my cap to you. This is something we were just talking about very recently. In fact, we had the folks from IB on our Pro Q&A, I want to say a couple of weeks ago, It was right after they had just gotten approval effectively to launch their product. So there are, as you point out, several marketplaces now. The one that really got the ball rolling here in the US is Kalshi, Kalshi. And people were hitting me up, I should say, about them earlier this year. And I looked at them, I thought, well, what is, I don't really know this platform. It's another binary player. People I knew in the business were saying, no, this one's different. They're legitimate. They're actually going for approval here in the US by the SEC. And sure enough, they did that. And the folks at IB, Thomas, a clever fellow that he is, they piggybacked on effectively what was the lawsuit started by Kalshi so they could get approved for their products too. So now we have the Kalshi markets, and we have, I believe, the IB markets are called Forecast EX. That's the name of the marketplace. Now, don't be confused. It's a wholly owned subsidiary of IB, so they own it all. But those also are effectively binary options products. I just saw some rumors that Robinhood's going to get in the game as well. So the Kalshi lawsuit seems like it really opened the floodgates to these binaries. But that's effectively what they are. You point them out correctly. These are binary options. Most of them are going to use the standardized convention of binaries now, which was really, I think, kind of pioneered by Nadex, or if not pioneered, at least popularized here in the UX, which is effectively the price of the binary is going to be the probability of the event coming to pass. So if you think Trump winning, for example, is going to be a 60% probability, then that binary probably be trading, 58, 62, somewhere around that level. So the price and the probability are inextricably linked, and that makes them, I think, reasonably intuitive for a lot of people to understand. But they are interesting venues. It is nice to have things that are A, SEC approved, B, listed on venues. Maybe not Kalshi. No one's really heard of Kalshi. But, IB people have heard of. They know you're not really going away anytime soon at IB, even though maybe Forecast EX is a newer entity that maybe you're not familiar with. And again, Robinhood, if they get some skin in the game as well, people are certainly familiar with them. So this is opening the floodgates to some very interesting new things. I'd like to go around the horn and get everyone's thoughts. Zed, we'll start with you. Have you been paying attention to this side of the space? It is certainly growing. And then the aptly named Los Excelente wants to know, what are your thoughts on these new venues? Do you think these types of event contracts will become a larger part of the asset management landscape going forward?
Yeah, I just think it's difficult to figure out where they would sit in current products in the asset manager space, whether it's true asset management, even if frankly hedge fund community. I think the market makers are going to love it. They'll definitely enjoy more product with nice edge, as you say. They'll probably trade 58.62. Market makers haven't seen edge and something like that in a long time. But I can't come up with where I think you get substantial growth where it converts it from, I'll call it more like a sports betting market style of environment into true asset management.
I think you hit on it right there. If they can crack the sports wagering side of it, and now you have real binaries on, let's say, Kansas City versus Dallas, something like that, or the Super Bowl, I think that's something a lot of people can get behind, and they understand intuitively, maybe more so than they do a 10-year note or something like that. So that's certainly, I know from talking to people like Nadex in the past, that was kind of the holy grail. They never thought they would even get approval for these things. So the fact that we're this far already, I think Kalshi also listed markets on things like the Oscars. So we're treading some interesting ground here, which again is similar to what we were saying earlier with the 0-day options. Some new products in the game that weren't in the mix even in the last election cycle. Matt, we're coming up against it, so I guess the last word on this will be yours. What do you think about these new venues? Have you seen them? Are you paying attention to them? And he wants to know, do you think these types of event contracts will become a larger part of the asset management landscape going forward?
Yeah, I mean, I think this is a good test with interactive brokers in there. And it was funny that the Biden administration really tried to get them to shut down because it showed Trump winning so much. So I thought that was pretty funny. But what it's done is, as the percentage for Trump went up, then our implied moves have come down. So I think it's not only going to grow a bit, but I think it's going to educate some other options trading around what people are betting on in this binary. So you know me, I like I like the zero DTEs. I like to give people the chance to make markets on these things. I stay away from them generally because of the markets are so wide and people know so much more about it. But I think that their existence helps what we're trying to do out there is really put a number on risk for many different things. So that's my feeling, Mark.
Yeah, they are fascinating to watch as they grow. I think we've really only just seen and just scratched the surface of what this event marketplace can eventually be. I know CME has attempted these products as well. They haven't really set the world on fire, but then again, they had a kind of obtuse nomenclature at first. They were 1/5 the size. You had to multiply by 5. It wasn't anywhere near as straightforward as these products are. They have since corrected that, so that will hopefully maybe improve some of the volume out there. But yeah, this is interesting. Also, great timing on the question because it does dovetail very well with what we were saying at the end of the day. Hedging specific event risk. This is another way you could go about it. Binaries were literally designed around speculating and hedging very specific. Usually it's very minute movements or events, but at the end of the day, that's something they can be used for. I think, as Zed alluded to, it's going to bump up against the same issues we're seeing with zero day, which is kind of just the busy work factor. If you're trading a lot of binaries for your clients, it's a lot of management, a lot of time management you're going to have to spend doing that where you could be doing other things for your clients. So I think for this audience, that might limit some of the utility, but I know for a lot of the active retail and even some of the institutions out there who are looking at this, I think it's certainly intriguing. And where we go from here, if they can crack that nut, get into the DraftKings arena of the world, start siphoning some of that money away with real tradable products on venues and platforms you've actually heard of, I think that could be a game changer for these. But for right now, yeah, I don't think a lot of our advisor listeners are going to be slinging them, but very intriguing. Unfortunately, that music, which I think Zed said is, what do you say, offspring music. Zed, as that music plays, that means we are out of time for this episode. But before we go, if our listeners are intrigued, they want to learn more about what you and the team at Convexitas are up to, where should they go? What should they do?
Yeah, definitely find us on LinkedIn or our website, convexitas.com. We'd love to have a consultation. And if you're really thinking about doing any sort of option-related work for your client accounts, at worst, you should give us a call and get a little bit of an education dump for all the things you need to be wondering.
There you go. Get the education dump. That could be your branding. Get the education dump over there at Convexitas. I'll spell that for you, listeners. It's not an easy one. Convexitas. Search for that, and you can hit up Zed and the rest of the team over there. And Mr. Matt, since the last time I chatted with you, you folks went live with your live data. So again, congrats on that. How is that going? And what else is under the hood over there at ORAT, sir?
Yeah, it's been going great. People are able to trade live and then also get APIs of live options data, our great skew summarizations, good Greeks and all that fast. So it's been a challenge. We're busy. And come on over to orats.com and check it out, Mark.
Orats.com, the place to go to kick the tires and light the fires. You too can chat with everyone's favorite rogue AI known as Otto. Just don't give him any personally identifiable information or he'll come knocking on your door in the middle of the night. Orats.com, the place to go to kick the tires and light the fires. And while you're surfing online, make sure you check out our friends over there at the OIC, the Options Industry Council, optionseducation.org, the place to go to learn more. And check out, they have their own little series they do here on my network called The Wide World of Options, where they dive deep into all things options. They touch on the advisor side as well. So if you're looking for a little bit more education, a little bit more information, you should check that one out as well. That's going to do it for us on the network today. Back again tomorrow for our newest doubleheader, the Futures Rundown, as well as everyone's favorite Options Bootcamp. Thursday, of course, another doubleheader of the option block and This Week in Futures Options. Friday, vol views. And then for our pro folks, we come back one final time for the week for Options Oddities. Then we're back again next week, gearing up for the big election night extravaganza. So mark your calendars, listeners. Should be a fun one. And we're back again, of course, next month, another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.